Bitcoin started as an idea that could completely change the way the world thinks about money. But what exactly is Bitcoin, and how did it become so valuable?
Bitcoin was introduced in 2008 by the mysterious Satoshi Nakamoto. In 2009, the Bitcoin network officially began, creating a new kind of digital money.
At first, Bitcoin was almost worthless, but as more people discovered its technology, a small digital experiment slowly became a global financial phenomenon. In 2010, Bitcoin was used to buy 2 pizzas for 10,000 Bitcoin, a transaction that showed digital currency could have real-world value.
Value didn't rise in a straight line. It experienced dramatic rallies, sudden crashes, long periods of uncertainty, making volatility one of its defining features.
As Bitcoin attracted more users, exchanges began making it easier to buy and sell. But this new market also introduced serious risks.
By 2013, Bitcoin had entered the global spotlight, attracting investors, technology enthusiasts, and people searching for an alternative to traditional money.
In 2014, Mt. Gox collapsed, showing the world how risky crypto exchanges could be.
After every major crash, Bitcoin kept coming back. More people began seeing it as a new kind of digital asset. By 2017, Bitcoin entered one of its biggest bull runs, reaching nearly $20,000 before a dramatic crash.
That crash taught investors an important lesson. Bitcoin can rise incredibly fast, but it can also lose value just as quickly.
Then, in 2020, Bitcoin entered another major growth cycle as companies and large investors started paying much closer attention. In 2021, Bitcoin reached a new record near $69,000, driven by huge global interest. Then came 2022. Bitcoin entered another major downturn as rising rates, fear, and failures across crypto pushed prices sharply lower. Bitcoin survived the crash, and by 2023, the market began recovering as confidence slowly returned. In 2024, the launch of spot Bitcoin ETFs in the United States brought even more attention from traditional investors. Bitcoin's supply is limited to 21 million coins. That scarcity is one reason many people compare it to digital gold.
But scarcity alone does not guarantee value. Bitcoin's price still depends on demand, trust, adoption, and market conditions. Now let's understand how Bitcoin actually works and why no single bank controls the network. Bitcoin runs on a blockchain, a public digital ledger that records transactions across a worldwide network of computers. Every transaction is verified by the network before it becomes part of Bitcoin's permanent record. Instead of one central authority, Bitcoin uses thousands of computers to help maintain and secure its network. Bitcoin mining helps secure the network. Miners use powerful computers to process transactions and compete to add new blocks.
When a block is successfully added, the miner can receive a Bitcoin reward, helping keep the network running. Bitcoin is also divided into smaller units, so you don't need to own one whole Bitcoin to buy or use it. The smallest unit of Bitcoin is called a Satoshi. One Bitcoin contains 100 million Satoshis. To own Bitcoin, people usually use a crypto exchange or a digital wallet to buy, store, and manage their coins. A wallet doesn't store Bitcoin itself. It stores the private keys that give you control over your Bitcoin.
Private keys are extremely important. If someone gets them, they may be able to control your Bitcoin. That is why Bitcoin security matters. Never share your private key or recovery phrase with anyone.
Now let's look at Bitcoin trading and how people actually buy and sell it around the world.
Most traders start by choosing a reputable crypto exchange, where Bitcoin can be bought or sold for traditional currency.
After funding their account, traders can choose to buy Bitcoin at the current market price or place a specific limit order. A market order executes quickly at the available price. A limit order only executes at your chosen price or better.
Traders can also set stop-loss orders, which can automatically sell Bitcoin when a chosen price is reached.
Another option is dollar-cost averaging, where someone buys small amounts regularly instead of trying to predict the perfect price.
Some people trade for short-term moves, while others hold Bitcoin for years, believing its long-term value may increase.
Bitcoin can also be traded against other assets, such as the US dollar or stablecoins like USDT. Bitcoin trading is available around the world, 24 hours a day, 7 days a week.
But 24-hour access also means prices can move sharply at any moment.
This volatility can create opportunities, but it can also cause serious losses, especially for inexperienced traders. Leverage can make trades much larger, but it can also multiply losses. Beginners should understand the risk before using it. Another major risk is emotional trading. Fear and greed can push people into decisions they later regret. Never invest money you cannot afford to lose. Bitcoin is volatile, and there are no guaranteed profits.
Always research the exchange before using it. Check its security, reputation, fees, and withdrawal policies first. Be careful with fake websites, fake apps, and people promising guaranteed Bitcoin profits.
Never share your password, private key, or recovery phrase. Real support will never ask for them.
Another danger is phishing. Always verify the website or app before entering your login details or wallet information.
Bitcoin transactions are recorded on the blockchain, but your real-world identity is not automatically displayed.
Bitcoin offers transparency, but transactions can still be traced through their public blockchain records.
Bitcoin can be sent across borders without using a traditional bank, making global transfers possible at any time.
However, Bitcoin payments can be irreversible, so sending coins to the wrong address can mean losing them.
Bitcoin can be useful for global transfers, but network fees and confirmation times can change with demand.
Bitcoin is not controlled by one country, company, or central bank. Its network operates globally.
That global network is one of Bitcoin's biggest differences from traditional banking.
Bitcoin can also be held as an investment, but its price can change dramatically in a very short time.
Bitcoin has potential, but potential is not the same as guaranteed profit.
One of Bitcoin's biggest strengths is scarcity, but scarcity alone cannot determine its future price.
Bitcoin's future depends on adoption, demand, technology, regulation, and how people choose to use it.
Regulation can also shape Bitcoin's future because governments around the world treat crypto in different ways.
Some countries welcome Bitcoin, while others restrict or regulate its use. Always check the laws where you live. Before buying Bitcoin, understand the risks, fees, taxes, and rules that apply in your country.
And taxes may also apply to Bitcoin activity, so keep accurate records of your purchases, sales, and transactions. Bitcoin can be stored on exchanges or personal wallets, but each option has different security risks.
Cold wallets can reduce online risks, but losing the recovery phrase can mean losing access permanently. Bitcoin's price history shows one clear pattern. Major gains have always come with major risks.
That's why smart investors focus on risk management, not just the possibility of making money.
Never put all your money into Bitcoin. Diversification can help reduce the impact of one asset falling sharply. Bitcoin can be part of a portfolio, but your decision should match your financial goals and risk tolerance. Before trading Bitcoin, decide how much you can realistically afford to risk, and never trade with borrowed money.
One of the safest habits is simple. Research first, invest carefully, and never rush because of market hype. Markets move on information, expectations, fear, and demand. No one can predict every Bitcoin price move. Bitcoin can offer opportunities, but responsible decisions matter more than chasing quick profits. History can teach us what happened before, but it cannot guarantee what Bitcoin will do next.
The smartest approach is to understand Bitcoin first, then decide whether it belongs in your financial plan.
Bitcoin is neither a guaranteed investment nor a guaranteed failure. It is a high-risk digital asset that requires careful research.
Bitcoin's history is a story of innovation, extreme volatility, and a financial experiment unlike anything before it. Today, Bitcoin is used for investment, payments, transfers, and as a store of value by people around the world. But Bitcoin is not risk-free. Prices can fall quickly, scams exist, and mistakes can permanently cost you money. Before buying Bitcoin, ask yourself one question. Can you handle a major price drop without panicking? If you cannot handle that risk, Bitcoin may not be right for you. Never chase a rising price. A disciplined trader follows a plan instead of reacting to market hype. Good traders understand both sides, the opportunity to gain and the possibility of losing. Bitcoin's biggest lesson is simple. Understand the risk before you focus on the reward. Bitcoin may continue evolving, but nobody can know its future price with certainty. Before making any decision, learn the basics, compare reliable information, and understand what you could lose. Bitcoin's history proves one thing. Innovation can create opportunity, but risk is always part of the journey. Bitcoin is powerful technology, but using it safely requires knowledge, patience, and responsibility. Never trust anyone promising guaranteed returns. In crypto, guaranteed profits are a major warning sign. Bitcoin can be valuable, but education and security should always come before investing your money. So, is Bitcoin right for you? That depends on your goals, your risk tolerance, and your understanding of the market. After more than a decade, Bitcoin has become a global digital asset, but its journey is far from over. Whether Bitcoin grows or changes, one thing remains true. Knowledge is the most valuable investment you can make. Bitcoin's story is still being written, and its future will depend on adoption, innovation, and trust. Bitcoin is not a shortcut to wealth. Treat it as a high-risk asset. Learn first and make decisions carefully. Bitcoin also taught markets a powerful lesson. Rapid growth can bring enormous excitement, but also enormous volatility. Now, let's summarize the most important lessons from Bitcoin's remarkable journey. Bitcoin proved that digital money can operate without a traditional central bank or single controlling authority. It also showed that decentralization comes with responsibility. Users must protect their wallets, keys, and personal security. From a few cents to thousands of dollars, Bitcoin's price history has been one of the most dramatic in financial markets. Bitcoin's limited supply is one reason people view it as scarce, but demand ultimately drives its market value. Bitcoin's future will depend on adoption, technology, regulation, and global demand. Whatever happens next, Bitcoin has already changed how the world thinks about digital money. It challenged the traditional idea of money and showed that value can move through a decentralized network. But Bitcoin's success also created thousands of new projects, technologies, and ideas across the crypto industry. Some projects succeeded while others failed, reminding investors that innovation always comes with risk. That's why research matters. Never invest simply because a project is popular or trending online. Bitcoin's journey also shows why financial education matters in a rapidly changing digital economy. If you understand the technology, the risks, and the market, you can make more informed decisions about Bitcoin. And that brings us to the end. Bitcoin changed finance forever, but its next chapter is still waiting to be written.